Good morning, everyone, and welcome to what is the third webinar we're doing. This is on financing power projects, and I'm glad to be joined by three distinguished guests who have all been involved in financing such projects over the years. I have Amara Ibrahim from Nedbank, who's an associate within the energy department. I have Feda Swart from FMO, who's an investment officer also within their energy department, and Mutali Mukuka, who is the CFO from the Copperbelt Energy Corporation. And just see you've been there for over a decade, so congratulations on that milestone achieved. So we're going to run through certain aspects of what it involves to sort of finance a project. As people will appreciate, around, or up to about 80% of the cost of a project gets financed by debt financiers, such as those we have on this panel here today. And therefore they become, I shouldn't say this to them, but the most important people potentially on the transaction, and often sort of dictate the terms and the requirements for a transaction. And therefore, a lot of what, from our example, what we do when we're looking at us being a credit-worthy offtake for power projects, we have one eye on what the developers do, but our more dominant eye is really towards satisfying the requirements of the lenders, because ultimately it is them you have to please to make sure that the financing comes in to allow the project to happen. So their involvement and their requirements are very important to any of these projects, and we'll get to sort of hear what those are over the course of the presentation. And Mutalia, last of all, will sort of present his position from as a developer of projects and someone who's looked at certain alternative financing options to how to sort of develop those projects, which is very interesting, I think. So without ado, I will let the presenters introduce themselves more fully when they present their presentations, and I will hand over to Feda, who's going to start with his presentation.
Thank you, Pug. Welcome everybody to this webinar. My name is indeed Feda Zwart. I'm a senior investment officer in FMO's energy team. I primarily cover Eastern and Southern Africa, but also looking at some projects in Northern and Western Africa. I've been with FMO for more than 14 years now, of which the last 7-8 years in African energy. And I'm excited today to share a bit of what we do as FMO. How we look at projects in Africa, what, let's say, the due diligence process looks like, and what the key attention points for us are. And please feel free to ask any questions. I designed the presentation. There's a lot of information in there, but if there's anything unclear, please let me know, and I'm happy to answer any questions. Maybe to start quickly with FMO itself, for those who don't know the bank. Next slide, please. There I have a short introduction. So FMO is a Dutch development bank. We are celebrating next year our 55th birthday. We have 3 focus sectors where we think the impact of our financing is the highest. That's agribusiness, food and water, financial institutions, and energy. And energy is about 25% of our balance sheet. We are a licensed bank, so we have to comply with all the regulation from the Dutch Central Bank, and we have a AAA rating, which also allows us to attract funding at lower rates, which we can then pass on to the projects ultimately. That's of course the goal. Next slide, please. So here you can see where we, let's say, what the key areas are where we work in. So we are, of course, focused on low and middle income countries. We have a large part of our portfolio in Africa, over 4.4 billion. Also within the energy department, Africa is our key focus. We have also 2 local offices, which also emphasize, let's say, our focus on Africa. So we have an office in Nairobi and an office in Joburg, but the headquarters are in The Hague. That's also where I'm currently based. As you can see, we are active globally in emerging markets or low and middle income countries. Next slide, please. So this is our investment process. I think the key takeaway here is that we have a 2-stage approval process, and we'll talk a bit more about that later in my presentation. But It starts all with the clearance in principle. So that's more like a desk-based assessment. We don't really need to travel. We don't employ any consultants. It's basically whatever we get from the project that we study, that we analyze, and that we present to our credit committee if we think it's a bankable proposition. If that has been approved, so let's say until that step has been taken, there's usually no cost involved for the client. We enter into the due diligence phase, and that can be a very it can be a very short process, but it's usually a very long process, unfortunately, especially doing projects in Africa. It involves a lot of consultants, which we will discuss also later on. It usually takes 6 to 8 months, 6 to 18 months to complete this step. Once we have completed it, we go to our investment committee again with our final proposal based on all the research we've done over the months after the initial clearance. Then follows the decision, either approved or not approved. Usually, I must say, fortunately, it's approved, but also because, of course, all the work we put in that process to make it, to identify the risks and to mitigate the risks to the extent possible. Then the contracting starts. That's basically all the project documents, the financing documents have to be drafted and agreed and negotiated. And then finally, we can go to the financial close or the first disbursement, after which we are usually in the project for 18 to 20 years because we are really focusing on the long-term loans where we have the most added value. Next slide, please. So the next few slides will deal with the due diligence. So this is, let's say, the process whereby we go through the whole project from legal, technical, environmental, social. Every aspect is turned upside down. Let's say what I'm trying to do here in the next couple of slides is to show what we generally see as bankable and as acceptable as an institution to provide our funding to. And because, as Pug said, indeed, we usually finance up to 80% of the project. We are in there for 18 to 20 years. So we have to make really sure that we are comfortable with the risks we're taking. I'm starting here with the PPA because for me, and I think that's probably for most people in the energy financing, the most important document to look at, the power purchase agreement. So the agreement between the project and the off-taker. Usually, the first thing we look at is, okay, is this off-taker creditworthy? Do they have a good payment track record towards their independent power producers? And if not, is there anything we can do to mitigate those risks? Usually in the form of a PRG. So that's a partial risk guarantee, for example, from the African Development Bank or from the World Bank, which is kind of an instrument to support the creditworthiness of the off-taker. But this is, of course, key because we need to be repaid. The payment, there's only one document, let's say, which kind of sets out the whole payment provisions, which is the PPA, and the counterpart is, of course, the crucial party to look at there. So off-taker creditworthiness is something that we look at from the first beginning. Then the currency provisions. Usually, what we see, and especially also in the African continent, is that the PPA, the tariff is payable in dollars. Sometimes there is local currency PPAs, but then usually still indexed to dollars, and that's also because the debt is payable in dollars. Usually, the equipment is payable in dollars, so it makes sense to do this in dollars and also to get repaid in dollars. But of course, it also means that the off-taker needs to have access to dollars, which is not always an easy task. The tariff, of course, it needs to be sufficient to cover both the debt and equity returns. It needs to cover the OPEX of the project. There needs to be an inflation indexation to make sure that 15 years down the line, we can still pay for the people doing the maintenance. So this is another point to look at. Then the tenor, usually you need more than 20 years to repay the whole project. What we see is typically 20 to 25 years, sometimes even longer. For example, if you have a hydropower plant, the technical life of a hydropower plant is quite long. So sometimes you can see that you have also longer PPAs there. But in any case, we always look at the tenor of the PPAs because we need to have some kind of tail between the end of the PPA and the end of our loan, just as a buffer. Because if the PPA ends, again, there's no cash flow and we can't get repaid. So we need to have a little bit of buffer there. Then we look at the dispatch provisions. Is it take or pay? Or do you get paid for whatever you produce? Which is, of course, much riskier. Usually we have take or pay provisions and deemed energy provisions. So if there is, even if you are curtailed, you still need to get paid for whatever energy you were able to generate. Otherwise, it is up to the off-taker to kind of decide, okay, we don't need the energy, we're not going to pay you, but that then, of course, means that you can't pay your debt or can't pay your people doing the maintenance, you can't pay your equity returns, so then you get into trouble. Force majeure, yeah, of course, you need to be able to claim relief in case of natural disasters, political unrest, war. You need to be able to say, okay, this is a situation, we can't help it, but we can't deliver the energy. So this is a force majeure situation. Change in law, change in tax. So you need to be protected. Again, you have an asset. It is at a certain location. You can't move it. It is going to be there for the next 20 years. So if suddenly the law says, you know, you can't sell energy, or the tax law changes and suddenly you have to pay 50 or 60 or 70% of your profits. So it changes the whole situation of the project. So you need to be protected against these changes. You make certain assumptions when you build the project, and these assumptions have to remain in place for the entire tenor of the PPA. Termination payments, of course, it can happen that the PPA is terminated for example, for prolonged events of default. And then we would expect at least to get our debt back. And usually that means that also the government takes over the project. Then the technical specifications, yeah, you need to be able to have a grid interconnection. And finally, the dispute resolution and governing law, usually English law in Africa. Yeah, I think that's basically the PPA. Next slide, please. Then the next one is the implementation agreement, or the concession. Again, here, this is more between the project and the host government. So not the off-taker, but here it's really the government, usually a ministry, that signs the implementation agreement and kind of awards the concession. Yeah, I'll keep it a bit brief, but here, yeah, you of course need to have usually some kind of government support. As I just mentioned in the PPA, you have an off-taker. It's not always the most credit-worthy off-taker. So usually what you're looking for is the government to provide a backstop on the off-taker and say, okay, if they don't pay, you can come to the ministry and we will make you whole if you're not paid your full invoices. You need access to the land. You need to be able to convert your currency. So even if you get, for example, paid a tariff in local currency, you need to be able to convert that into dollars and to transfer it offshore to your investors and to your lenders. Also here you have some change in law, some force majeure provisions. You need to be able to have access to the transmission infrastructure, to the grid. Again, here usually you see some tax and customs provisions. Can you freely have your solar panels or wind turbines enter the country, or what do you need to pay? Is there potentially a tax holiday because the government wants to stimulate development of renewable energy in the country? So all these kind of provisions you would usually see in the IA. Yeah, and generally for let's say the legal due diligence, what we really ultimately, what it all comes down to is that we allocate the risks to the parties best able to manage those risks. So for example, the currency convertibility and transferability, the government has control over that. So we allocate that risk to the government. There's also certain, so lenders take the credit risk, we do our due diligence, so the credit risk is more for the lender. So all the risks have to be allocated to the party who can really manage the risk. And that's ultimately the goal of the legal DD. Next slide, please. Okay, then we have a technical due diligence as well. We need to assess the resource. We need to see, okay, what is the solar irradiation? What are the wind speeds? What is the water flow? We have to forecast that under different scenarios. So we have the P50, which is, let's say, the 50% of the time you make more and 50% of the time you make less. The P90 is 90% of the time you will make that that specific yield, and 10% of the time you will not make it. So it's kind of a statistical analysis. P99 is, yeah, you're almost 100% sure that you will make this yield on an annual basis. So it's really, yeah, looking what is the worst case scenario, so to say, in terms of production. And of course, this needs to be reflected then in the financial model. We look at the equipment selection. Is it suitable for the site? Can it handle the temperatures? Is there heavy rains? Do we need extra foundations? So all these kind of things are taken into account. The degradation rate, of course, you have a major issue if the degradation rate is higher than what you expected, because it means that you will produce less energy and that you are not able to pay your debt or even not pay your OPEX, right? So these are really critical things to have reasonable assumptions there. The supplier needs to be reviewed and investigated. What is their track record? Do they have adequate warranties? Do they have financial health? Because you don't want to be in a halfway construction and suddenly your EPC contractor or your supplier goes bankrupt, right? So this needs to be investigated as well. Then we're looking at the grid interconnection. Is there sufficient capacity? Can you evacuate the power? Or is the grid very congested? And then will you not be able to evacuate the power, which is, of course, a major problem because your energy won't be used and potentially not even be paid. And is the transmission infrastructure there? Sometimes, you know, we see a very nice project, but there is no transmission line yet. And there can, of course, be promises. The transmission line will be finalized in 5 months or in 10 months. But yeah, in reality, sometimes, especially if you have long transmission lines, this can take very, very long because you need to move people, you need to build the infrastructure. And yeah, also from our own experience, this has really can really cause major problems for a project. Next slide, please. Okay. Yeah. Furthermore, part 2 of the technical analysis, the site conditions. Is there erosion? Are there flood risks? Is there maybe earthquakes? Can we actually transport the equipment to the site? If we are in a very remote mountainous location, can we actually get wind turbines there, right? And how do we do it? Do we need additional access roads? So all this needs to be investigated and we need to get comfortable around those conditions. Then we look at the construction plan. Are the milestones realistic? Are there potential delay factors? What is the worst case scenario again? And how do we mitigate it? If there is a delay, do we get liquidated damages? So is the EPC contractor going to make up for those delays and be able to cover any? So for example, if you have a few months of delay, then you would expect the EPC contractor to pay a certain amount that covers the initial debt repayments or whatever cost you have, which are caused by the delay. And this also ties into the evaluation again of the EPC contractor's track record. You want to make sure that they deliver on time and high quality, and not just the cheapest solution, which is of course also a consideration. But I think for us, the quality control and the track record is more important. Then the O&M, that's of course after you have built the plant. Who's going to do the operations? Who's going to do the maintenance? Is there an adequate maintenance plan? Is there an adequate maintenance reserve? Is the contractor again capable of doing all this maintenance? Yeah, what are the costs of maintenance? And this all needs to be reflected in the financial model. So both the technical inputs, and then we usually also take into account the sensitivities. Again, what is the worst case scenario? And are these worst case scenarios also adequately covered by contingency budgets? We always need to see that there is 5% or even 10% for example, for hydropower plants as a contingency to make sure that if there's any cost overruns, we can cover those from the existing budget, and we don't need to go back to the drawing table and see who's going to pay for these overruns. And becoming more and more important is the climate risk assessment. What we see is that in a lot of countries, there's what we expected to be once in 100-year drought, for example, or once in 100 years rainfall is now becoming more customary. And we see that sometimes on an even 5-year or even 2-year basis, that we really see exceptional weather circumstances, which we didn't really take into account. And in particular for hydropower, this can be a major problem, but also for wind, if wind directions or speeds change, this impacts your financial model and your revenue. Next slide, please. Another very important work stream is environmental and social. So what we usually expect to see before we start the due diligence process is an environmental and social impact assessment. That is part of the development works. So we need to understand what is the impact on the environment, on biodiversity, on the ecosystem, and potentially also on communities living there. That's actually, if there is communities living on the site or are economically dependent on that site, that can really cause issues, and you need to make sure that these people are compensated in the right way. But it's not always easy, because the land rights are sometimes not very clearly defined. People can live there maybe already for a long time, but without real land rights, right? Similarly, sometimes you have people more nomadic, traveling around, moving around, still being dependent on a certain plot of land, but only for a certain period of the year. You need to map this all and to make sure that you have a very good picture of who is dependent on this land and how can we compensate them, or if there's any resettlement needed, how will we resettle them, how will we make sure that there is minimal impact on their livelihoods. The more, of course, you need to resettle people, the longer the process will take, and the more potential also for reputational risks and other financial risks as well. That ties a bit into the community and stakeholder management. So sometimes there is indigenous peoples living on the site. Those peoples have been living there from pre-colonial times, and they see themselves as very different from let's say the other population, usually still with their own culture, etc. So these then especially becomes very difficult to manage, and what we require then is a free and prior informed consent. FPIC means that everybody of that indigenous community has had a chance to give their consent, fully informed and without any pressure from outside. So these are very, very critical steps that can really take up a lot of capacity to manage this properly. But it needs to be done early on in the process, because otherwise it can really cause a lot of issues later down the line. More logically, of course, the labor and working conditions, health and safety management. Are the workers safe? Do they have the right PPE? Don't they work too long? Do they have adequate housing on site? All this is taken into account. And something which is becoming more prominent is the supply chain due diligence. So what we see is that a lot of panels come from China, and of course, we have all heard about the human rights allegations, abuse allegations in the Xinjiang province. So we want to make sure that we don't have any panels or components which are made using basically slavery. That's what it is. So that's something we are more and more focusing on. Next slide, please. Okay, then finally, the commercial DD. So what we do is we size the debt. It can go up to 80%, but I think more common is maybe 75 or 70%. And how do we size the debt? We look basically at the debt service cover ratio. So what is the debt service cover ratio? It's basically the ratio of cash flow available for debt service. So that's revenue minus your OPEX, etc. And then we compare that to the debt service due in a certain period. And what we want to have there is some buffer. So for solar, the buffer can be a little bit lower because the predictability is quite good. So it's 1.2. Then for wind, it's a little bit higher. And for hydropower, it really depends on, okay, do you have a run-of-river plant? Do you have a peaking plant? Do you have a baseload plant? So it depends a bit on what you want to achieve with the plant. And based on that, you can do an assessment of what the adequate debt sizing is. Furthermore, we look at the sponsor. So are they financially strong? You want to make sure that they have the means and the ability to build a project, to manage the EPC contractor, to attract the funding. This is really a lot of work. So it costs a lot of manpower, it costs a lot of money, and you need to have some experience in doing it, because if you are a first-time developer, we basically always recommend to take on board a strategic investor to guide a bit in making the project work, because it's really it can be quite a complicated project. And of course, a small solar project is easier than a big hydropower project, but still, I think all of the projects would really benefit from a good, strong and experienced sponsor. What is the risk we're taking? So are we taking a fixed price risk, or is it a merchant risk? I will talk a little bit more about that in the next slide. We look at the energy demand projections. So does the country actually need the energy, or is this not really needed, or can't we evacuate the power? Is it also a low cost producer, or is this energy actually way too expensive for the country and they can't really afford it? So we also take this into account. Again, the financial model, including sensitivities, and we also look at insurance. Many things can happen to a site, or even before construction. Shipments can get lost or sink to the bottom of the sea. Your wind turbines can have major defects, or there can be storms or whatever. This is all should be covered by insurance. Next slide. So as you have heard, the due diligence is quite extensive. We don't do this by ourselves. We need external advisors. We are not all engineers and social experts and lawyers, so we have to hire these people externally. I've tried to give a kind of a cost indication of each advisor. So the LTA, Lender's Technical Advisor. Again, it really depends on if you are looking at a small solar project or a large hydropower project. So the range is quite broad. I would say most projects are a bit in the lower end of the spectrum, but definitely the costs can really go up quickly if you have a more complicated project. Similarly, for the Lender's ENS advisor, if you have to do major resettlements, the costs can of course go up. Lender's Legal, international and local. Again, this is really the major cost on the due diligence side. You need to look at the PPA, the IA, all the project documents, and you also need to draft the loan agreement. So these costs can go up quickly as well. And then the tax and model audit. You need to verify that whatever you put in a financial model is actually reflecting all project documents, and there's no errors in the financial model. So you need to make sure that somebody looks at that and signs off on the model and on the tax provisions. Next one. So if we are there, the early development projects have been completed, we go for our initial approval. We start due diligence, as I said here, between 6 and 18 months. What drives the timeline? It's really, do we need, for example, amendments to the project documents? Do we need to change the design? Are there any changes in the total cost? So these kind of things can cause a lot of delays, because it changes every parameter in the project, which can really extend the timelines by a few months easily, or even years. Once you complete the DD, final approval obtained. Some banks need the board approval, FMO doesn't. But sometimes that can also cause a little bit of delay. Sometimes the boards are only once every quarter or so. So that's something that needs to be a bit managed. Then the drafting and negotiating of the finance documents, the common terms agreement, which is reflecting, let's say, the common terms agreed between all lenders. Then the facility agreements, where you have more the specific requirements for each lender. Intercreditor agreement, which sets out the provisions between the lenders, the voting, for example, security agreements, security and account bank agreements. We need to have always a security and an account bank in place as well, an accounts agreement, and the direct agreements with the government, with the EPC contract. So it's quite some agreements which need to be drafted, and that's also driving up the legal costs sometimes. Next slide, please. Yeah, then we are at the signing stage. So the documents have been signed. There are conditions precedent in the documentation which need to be fulfilled before the first disbursement can be made. So financial close depends on closing out some of the conditions precedent, or all of them, I should say. Yeah, it depends a bit. It can be sometimes very quick, or again, it can take a few months, but usually you can already start collecting CPs before signing. So yeah, if you really want to, you can keep this a rather efficient process. The advisors remain involved during construction. Well, similarly important as during due diligence, because now actually things are happening and we need to make sure that everything is happening in accordance with what we had assumed during the due diligence process. Then the major milestone, usually for the developer, the commercial operations date, you start generating your revenue. Your project is finished, you've done the testing, and you start, the PPA is starting, and you trigger payments and billing to the off-taker. So that's usually the big milestone. But then for us as lenders, we are still looking at two additional milestones, which is technical completion date and a project completion date. Technical is really satisfying all the lender technical requirements. So also the lender's technical advisors need to sign off on the whole project. And then a project completion date is usually when all the obligations of the sponsors are also released. This is really the final milestone. And then it's really the full technical, financial, commercial, environmental, social, everything has been completed in accordance with the plan, including mostly 6 months of off-taker payments. So then we are really, the project has a proven track record of meeting all those obligations and generating revenue, sufficient revenue to pay the lenders. Next slide, please. Briefly about what we are seeing, especially in Southern Africa, which is, in my view, a really good development because, as I said in the beginning, the off-taker can be really a problem or a bottleneck in making sure you have enough projects, because if you don't have a creditworthy off-taker and the government is not willing to backstop that off-taker, then basically you don't have a project. It all starts with the off-taker and them being able to meet their payment obligations. What we're seeing now I think the SAP is an excellent example, is that power plants are not necessarily selling to an off-taker, at least not a government utility, but through to the market. So basically, they're trading on the South African power pool. They just sell the electrons to whoever wants to use them, and the prices are set in the day-ahead market. So yeah, of course, this is a different model. You don't have the certainty of a fixed price. You don't have the certainty of being able to go back to a government if there's a non-payment issue, but you do have the certainty actually that you that there is a market, that people need the electrons, and that there usually this is also cash collateralized. So you have the dollars, or at least there's certainty of having the dollars when making that trade. So there's no real risk of non-payment. And this is, of course, a strong mitigant to the off-taker risk. So you don't have a PPA. You don't always need an IA, although it's usually quite strongly preferred because you need to be protected against expropriation or nationalization. You need probably some other government support as well, but it's more a small IA. The struggle a bit with these kind of projects is that they have a variable price. So they require a more flexible payment profile, for example, through a cash sweep. You can't say, you don't know what your revenue will be in a certain period. So you can't, let's say, really size the debt. You give a certain amount of debt, and whatever comes in is basically used to repay the debt in a certain proportion, of course, to equity and OPEX, etc. So it gives a bit more risk. but at the same time, there's also a risk mitigation in place. But the structuring is very different compared to a classical PPA model. Then we have the semi-merchant plants, which we're seeing, of course, with GreenCo, which is more based on commercial trader, aggregator, entering into a PPA with a power plant, selling the electrons. You don't have a government offtake, but you have a commercial counterpart. So you need to be comfortable around the credit risk of that commercial counterpart. The prices can fluctuate or be fixed, depends a bit on the agreement with the offtaker, but either you follow more the market or actually the offtaker is taking that market risk and giving you a fixed price for your project. And finally, commercial and industrial. What happens a lot now, what we see a lot is mines in Zambia, in Zimbabwe, that don't have a very stable supply of energy, and they are inviting IPPs to provide the power at a certain tariff. This is you need to again be comfortable around the offtake risk around the mine. Sometimes there's additional environmental and social considerations to take into account. But yeah, this is again also something which mitigates the offtaker risk to some extent. But what we see is that this is still a bit higher risk. So usually the margins are slightly higher for these kind of offtake projects. The tenor is a bit shorter. You want to be repaid quicker because nobody really knows what the energy market looks like in 18 years. And preferably you also want to share a bit in the upside because you're taking also more equity type risk. I think this is it. Was there a next slide? I don't think so. No.
No. So thank you, Fede. Just put my video back on. Yeah, there is obviously a huge benefit that comes with the debt financing coming in at the end. Unfortunately, there is a bit of a burden, and Fed is sort of giving you an illustration of that. So it's, there is a lot of due diligence, a lot of work is needed. And unfortunately, those costs that you saw are the costs which the developer has to pick up rather than being sort of met by the lenders in that way. There are some grant fundings available, which are sort of tend to be quite limited and depends on what's around, but they sort of can be available in the markets. But it is a costly business raising debt for a project, but obviously, hopefully, one that in the end you have a successful project that as a developer will earn you the returns that you're expecting. But it's you certainly have to be careful when you choose your financiers and very thoughtful about that process. Fede, you wanted to say something?
No, I just want to add, you're absolutely right. This has to be backed up by the developers, but at the same time, this can be usually recognized as equity once you achieve financial close. So then we include all these costs in the equity which has been already provided. So in that sense, it's more an overall project cost. We always expect sponsors to include about 20% of the total project cost. So this can be included under that.
So it's a cash flow issue rather than an eventual cost. Yeah,
absolutely. Yeah.
Fede, there was one question that came up that perhaps useful for you. Well, a couple of questions for you to answer just now. One was, are you open to all countries in probably more sort of Southern Africa we're talking about, and I expect that might be Zambia in particular, and how you choose your consultants?
So we are open for all countries in Southern Africa. We don't have exposure in all countries in Southern Africa. That mostly has to do with the regulatory regime or the fact that the government supports independent or private sector involvement in the energy sector. But where we are now very active indeed is Zambia. We're looking at Zimbabwe with great interest, Mozambique. Historically we've been very big in countries like Kenya, Rwanda, Uganda, which is more Eastern Africa. But this is really the area that we work in. Southern Africa, let's say South Africa, we do have some exposure, but it's more technologies like concentrated solar, which are more technically challenging. We don't really have a role to play in the renewable energy rounds because the commercial Amara can tell more about that, but commercial banks can fully cover that, so we don't really have additional role there. How we choose our consultants, it's a competitive tender, so we basically send a request for proposal, RFP, with a certain scope of work, and we send that to, I don't know, 5 consultants that we know, that we work with. We ask them for a price, and of course we also take into account their CVs, if they are able to deliver in time, etc. So it's kind of a competitive process.
Thank you for that. We'll answer some more Q&As towards the end of the presentation, but more general. But for now, Amara, let me hand over to yourselves.
Thanks. Thanks, Pug, and good morning to everybody on the call. My name's Amara Ibrahim. I am an associate in Nedbank's energy finance team, and Nedbank is one of the 4 largest commercial banks in South Africa, for anybody who doesn't know about Nedbank. And it's a pleasure to be part of this IPP capacity building webinar. GreenCo has created a great platform to upskill and empower IPPs across the continent, and no doubt will have a significant impact in shaping the future of renewable energy deals in Africa. So well done to the GreenCo team, and I'm excited to be part of this journey. I think everybody on the call can appreciate that the power sector in Africa is undergoing a profound transition and is constantly evolving across regions. And with this understanding and our strong mandate, Nedbank Energy Finance remains one of the largest and most experienced commercial financiers of IPPs and the power sector in Africa, and has been funding power projects and has been a key participant in landmark power transactions across the continent for almost over 2 decades. Next slide, please. So starting off in understanding what is a commercial bank and how does this differ to a DFI like FMO, which Fede explained their thinking around. So commercial banks are financial institutions primarily focused on offering banking services to individuals, small businesses and corporates. And unlike DFIs, which focus on the developmental impact, commercial banks emphasize risk-adjusted returns and profitability. And I think it's important to note that a commercial bank at the end of the day is a profit company, and so risk-adjusted returns are important. And Nedbank, like other commercial banks, are listed companies, so shareholders can be people like you and I. So risk-adjusted returns are very important. And then the roles of commercial banks in funding renewable energy projects, so project finance. Commercial banks typically play a significant role in providing project finance for renewable energy projects and can offer debt solutions modeled around the project's cash flows. And I'll dive into what these facilities typically look like. Commercial banks also assess project risks, including credit, operational, and environmental risks, to structure financing packages that ensure that the project meets the bank's hurdle return rate whilst managing risk exposure. So going back to the concept of risk-adjusted returns. And from initial funding through to the construction and operational stages, commercial banks can provide various facilities such as bridging loans, construction finance, and more typically long-term debt to support renewable energy projects across the life cycle. And I'll delve into the operations segment in a bit. And lastly, it really is a catalyst for private sector investment in renewable energy projects. Next slide, please. So just doing a bit of a comparison to DFIs. So as mentioned, that commercial banks are profit-driven institutions and so focus on generating returns for shareholders. And we will focus on lending to creditworthy projects and clients. And these are driven by market conditions, interest rates, and we'll focus on this risk-adjusted return, which I've mentioned. And in comparison, DFIs will focus on achieving the developmental impact and often operating with public or multilateral backing. And they may prioritize projects which may offer lower financial returns but have significant socioeconomic or environmental benefits. Just looking at similarities and differences. So whilst both commercial banks and DFIs provide essential funding, and we can collaborate on a blended basis. So we'll both undertake DD or the due diligence process and risk assessment, albeit with different thresholds and priorities. But all of the due diligence and processes which Fede mentioned is typically what we would consider as well. Then looking to the differences, as I mentioned, DFIs may offer concessional financing, grants, or other incentives which may not be typically offered from commercial banks. Fede can come in if I'm wrong there, but and I think DFIs can accept a higher risk for development goals, and commercial banks will require stronger financial returns and tend to avoid an early stage or high risk segment without government or DFI support. And then just key considerations for commercial banks. I think I've already touched on it, the risk and reward. Then creditworthiness and repayment structure. So commercial banks will focus on the borrower's credit profile and security of project cash flows, whilst DFIs may be a bit more flexible and support projects in a higher risk or emerging market. And then lastly, market-driven commercial banks are more market responsive, requiring competitive returns. Next slide. So just touching on the typical facilities which we as a commercial bank can offer, or we as an aid bank can offer. So first being term loans. Term loans are long-term debt facilities that primarily provide the primary funding for project development and construction. And the borrower will repay this loan over a set term from the project cash flows. VAT facilities are short-term facilities. They'll cover the upfront VAT costs during construction and then can be recovered once the project is operational and generating revenue. Or it's also repaid from the VAT receipts received. Debt service reserve facility. This is a reserve fund to cover debt repayments in the case of cash flow shortfalls. And this will ensure that the project can meet its debt obligations. We'll typically structure it at, it'll be a short-term facility, maybe 2 to 3 years, and it's often sized as your next 6 months of debt repayments. Maintenance reserve facility, so these fund future maintenance needs, ensuring that the project remains operational and generating revenue without unexpected expenses or impacting cash flows. However, we found that with mature technologies such as solar or wind, we're moving away from having these facilities. However, it's looked on a project-by-project basis. And then likewise, working capital facilities, these are also short-term facilities and provide funding for day-to-day operational expenses. These are revolving credit lines and can be drawn upon as needed to support the project cash flows. And then lastly, letters of credit or guarantees. These are forms of credit enhancements where we will assure payments or performance, reducing the counterparty risk. And for renewable projects, these may cover equipment purchases or any other essential contracts. Next slide, please. So looking at the other roles and offerings which we can provide, and all of this will then form part of a comprehensive funding package for a project. So firstly, the account bank. Account bank holds and manages projects, ensuring that the cash flows such as revenues, loan repayments are correctly allocated per the financing agreements. And they'll often manage reserve accounts such as the debt service reserve account or maintenance reserve account as well. Looking at your market instruments, which are your interest rate swaps and forward exchange contracts. So often we can be the hedge bank in a project, and commercial banks will offer hedging instruments to manage financial risks. Interest rate swaps help stabilize interest payments by converting a variable rate to a fixed rate, and this reduces the interest rate risk for the project. And forward exchange contracts allow the project to lock in exchange rates for future currency transactions, minimizing currency risk in the project, where you have foreign payments to be made, maybe in dollars or euros, or also in cross-border deals. And then facility agent role. So this is responsible for coordinating communication between lenders and borrowers, ensuring the compliance of the loan terms, distributing payments, and managing any amendments which may come up or waivers from the borrower. And this role is to ensure smooth communication and administration for project facilities, and becomes particularly important when you have several lenders on a deal or becomes a large syndicate. And lastly, preference shares. So commercial banks may structure preference shares as part of the project finance, and due to the tax benefits, commercial banks can offer preference shares at preferential rates, providing a benefit to the borrower and essentially the project company as a whole. Next slide. So moving on to considerations during the operational phase, and what we would monitor during operations and post COD. So after a project reaches COD and moves into its operational phase, commercial banks will still maintain an active role in monitoring the project to ensure that the project meets its financial and operational commitments. So I've just noted on the slide key focus areas. So first is financial performance. So we'll monitor cash flows, the debt service cover ratio, financial covenants, and we need to ensure that the project generates sufficient revenue to cover its debt obligations. What would usually review is the annual financial statements, annual financial model, to analyze performance. Next is revenue stability. So we'll often look at the actual revenue for the period and how it compares to its base case, and to ensure that payments are consistent and aligned with projections. We look at compliance with loan covenants. So this will be financial and non-financial covenants, ensuring the maintenance reserves are adhered to if applicable, and the project is fulfilling reporting requirements, adhering to any further restrictions or on additional borrowings or any restrictions per the facility agreements, and I'll touch on that in a bit. Also monitor asset and operational performance, and this is usually the most important aspects which we will monitor, and we want to assess the operational performance, including generation of the plant, efficiency rates, how healthy is the equipment, and is it working to its intended purpose. We'll also then monitor reports to detect early signs of potential issues. Regular maintenance schedules and performance reports are also reviewed to ensure that the project remains on track. And we'll also focus on the maintenance of key assets, and especially in renewable energy projects where the asset performance directly impacts revenue. So here, if applicable, we'll then monitor the maintenance reserve account usage if that facility has been used or drawn, as well as major scheduled maintenance to avoid costly downtimes in the future. Second to last, environmental and social compliance. So we will often ensure that the project adheres to the agreed environmental and social standards, and regular ESDD, environmental and social due diligence reports may be required, particularly if the bank is part of an Equator Principles commitment, which Nedbank and many other commercial banks are part of. And we have a dedicated social and environmental team who then look at these reports. And then lastly, insurance coverage. So we'll verify that all the required insurance policies, such as property, liability, political risk insurance, etc., remain in place and are renewed as necessary. And this also provides safeguards against operational or unexpected losses. Next slide, please. So just diving now into the operational reports, which we then will review, and these reports are often they're often included in the information undertakings in your project documents. So borrowers and the project company will understand what is required at FC to provide and the time periods thereof. So for example, the project may be required to provide the annual financial statements of all major project parties, as well as for the project itself within perhaps 90 days of the financial year end. So these will all then form part of the information undertakings for the project. So first is the annual financial statements. So this obviously allows us as lenders insights into the performance of the plant, and we'll review the revenue generated in the period, operational costs incurred which are necessary to keep the plant running, whether the project has taken on more debt, as well as its ability to repay its debt obligations, as well as asset performance. We'll look whether the project has been adding new PPE or if it's able to depreciate current PPE as intended, and then as well as project cash flows, inflows and outflows, highlighting liquidity and any cash reserves, which is crucial to understand the project's ability to service its debt. This is also then coupled with reviewing the base case financial model and comparing variances to the base case, which is locked in at FC, and understanding the reasons for the variance. So annually, the project company will typically then provide an update to the base case financial model, modeling actuals, and will then compare it to what was forecasted at FC and understand, is it reasonable for the variances we may see. Next is the compliance certificate. So these are compliance reports which are often provided when there's a distribution request, and noting it notes the compliance with the distribution conditions, and then also just to verify that the debt service cover ratio or any other financial covenants during the period are met to ensure that we can release cash for distributions. And I'll touch on the distribution process in a bit. So next is the annual LTA report. Sorry, previous slide, thanks. Next is the annual LTA report, which is also very important for us to review. LTA report provides a comprehensive technical assessment of the project and will cover the operational performance, maintenance, and any other technical risks. It's prepared by the lender's independent technical advisor, who is engaged during negotiations of the project prior to FC. And lenders will review the operational performance, assessing actual production efficiency against projections, ensuring that the project meets expected performance standards. And the report will also look to confirm maintenance practices are adequate and any technical issues which may arise. And should there be any technical issues, lenders will then review the identified technical risks and recommended mitigations from your LTA. And ensure that proactive measures are put in place to manage potential operational challenges. And lastly, we look to verify that the project complies with the technical covenants and operational standards as outlined in the project agreements. Next is the annual LIA report, so the insurance advisor report. And like the LTA, the LIA is an independent advisor who lenders engage with prior to FC. I think Fede also touched on the advisors which we will use prior to FC, and he mentioned the RFP process. So these are your two advisors who will typically then from FC continue on monitoring and working closely with lenders. And we will review the LIA report to confirm that all required insurance policies are in place per the finance agreements, and that there's adequate coverage. The report will also confirm that insurance terms, coverage, and renewals align with the facility agreements, and we'll also review if there's been any claims over the past year and any changes to the risk profile that may require an adjustment to the coverage. And lastly, the annual ESDD reports, environmental and social due diligence. So this report will assess the project's compliance with environmental and social standards, such as the equator principles, as I mentioned before, or IFC performance standards and any other lender-specific guidelines. So evaluates environmental impacts, social commitments, and community engagement practices. We will often review the annual report to assess any identified environmental and social risks and verify that any mitigants are in place if required. Next slide. So distribution requests, and this is probably the most important to the project companies and borrowers and want to get their returns out. So typically we'll look at the following steps to then approve a distribution request as one comes through, because it's also documented in your finance agreements in terms of what needs to be met for the project company to then take out distributions. So first is compliance with cover ratios. So as mentioned, the debt service cover ratios will be locked in at FC, and these are your minimum thresholds as well as historical and forward-looking ratios. And we'll check that the current debt service cover ratio meets or exceeds the minimum thresholds as outlined in the finance agreements. And usually must remain above a set ratio for a specified period per the finance agreements before a distribution can be made. Next is cash flow availability. So we'll often look to the cash flows available for debt service to confirm that enough cash remains after covering all the debt payments and reserve funding obligations. And then also looking to operating expenses, taxes, and any other immediate liabilities which are accounted for, confirming that the excess cash is truly available for distributions. Next is financial and non-financial covenant compliance. So again, this will be stated in your finance agreements, such as restrictions on additional borrowings or limitations on asset disposals, which can impact the project's risk profile. We'll also look at the distribution waterfall and the compliant with the payment cascade. So we'll ensure that the distribution follows the payment waterfall structure as agreed in the finance agreements, which typically prioritizes operating expenses, your debt service, and reserve funding before there can be any equity distributions, as well as if there's any subordinated debt, this also must be satisfied before any distributions to equity holders can be made. And then lastly, no existing or pending defaults. I think this goes without saying. We need to confirm that there's no ongoing event of default or breaches of the finance agreements. And any default would usually restrict distributions until the issue is resolved. Next slide, please. So the last concept which I want to speak on is lender step-in rights. So this is often what happens when something's going wrong. So when things go wrong on a project, lenders have a range of protective measures which can implement to help bring the project back on track. And a key tool in this process is the concept of a step-in right. And this is typically activated through your direct agreements with key project contracts, such as your EPC, O&M, or PPA. So what is the step-in right? This concept of the step-in right is to allow lenders to quite literally step in and take control of a project if the borrower or project company encounters serious difficulties such as financial distress, breach, or contract or operational issues, which may risk the project's viability. And as mentioned, the step-in rights are typically embedded within your direct agreements, and these agreements give lenders direct access to key project contracts, allowing them to take corrective action without them triggering a full default. So 2 points to mention here is that the direct agreements and the step-in right process is if the project company is breaching on a third-party contract, so like your EPC, O&M, or PPA, it's a third-party contract to lenders. However, any breach on these key contracts may impact the project's ability to generate revenue or to meet the required performance, which then may impact the project company's ability to service its debt. So that's why it's important for lenders to have this right and this ability to then rectify the project so that the debt can be serviceable. And lenders, and the second point is, lenders do not want to call an event of default that's looked at as an absolute last resort. So this is looked at as a preventative measure before we get to that point. And then just touching on the 3 direct agreements, so the EPC direct agreement, this is with your engineering and construction contractor, allowing the lender to step in and address any construction delays, quality issues, cost overruns, by taking temporarily control, may manage disputes or even replace the contractor if necessary. And this is during the construction phase. So looking to the operational phase, you'll have your O&M direct agreement and PPA direct agreement. Your O&M is with your operations and maintenance provider, allowing lenders to intervene in ongoing project operations. And if maintenance or operational inefficiencies are affecting project performance, lenders can then step in to ensure that the project operates at the required standards. And then lastly, the PPA direct agreement. So this is obviously with the off-taker under the power purchase agreement, and is critical because the PPA essentially underpins the project's revenue streams. And if a project is under financial or operational stress, the PPA direct agreement allows lenders to step in to ensure that there is revenue continuity by managing or restructuring the PPA terms, addressing breaches, or stabilizing the project performance to meet the PPA obligations. And the PPA direct agreement is often one of the most crucial components for lenders, and it secures the cash flows that enable the project to service its debt. So as mentioned, this is one of the most important contracts for lenders. Next slide. So just looking at the corrective measures then, if before calling an event of default, and the process to step in and activate the direct agreement. So before exercising our step-in rights or declaring an event of default, lenders will typically follow a remedial plan to manage the risks posed and resolve any ongoing issues. The steps may include the following on the slide, and this is just a simplified approach, and it's obviously on a case-by-case basis. So first is monitoring and early warning. So like all the steps I mentioned prior of what we monitor annually with the reports and information undertakings, we're constantly keeping alive to what's going on in the project. So we'll closely monitor project performance through regular operational, financial, technical reports, which I did mention. And early warning signs such as declining cash flows, operational inefficiencies, or covenant breaches will then trigger closer scrutiny by lenders. Second is engaging with project companies. Lenders communicate directly with the project company or via the facility agent to address specific issues, and we're constantly having an ongoing conversation with our borrowers, and this is aimed to understand perhaps root causes or encourage corrective actions by the borrower. So we always keep that line of communication open, even post FC. Third is technical and financial support. So if appropriate, lenders may offer temporary relief measures, and this may include extending timelines, amending loan covenants, or approving short-term financial support to help stabilize the project to avoid a default. Then 4, activating direct agreements and step-in rights. So if the issue truly persists and poses a serious threat to the project viability, lenders then may activate direct agreements. And key here is a serious threat. So lenders don't often look to activate step-in rights, and we've got perhaps over 50 projects on our books, and not once has Nedbank ever activated our step-in rights under our direct agreement. So it really has to be a serious threat to the project viability, and it's in the best interest of all parties that this then happens. So lenders will typically contact key contractors such as the EPC, O&M, or PPA parties to initiate the step-in process. as mentioned, taking temporary control over the project management, overseeing and restructuring operations to ensure that the project once again becomes compliant with the contract terms. And lastly is implementing remedial actions under the PPA. And specifically for the PPA, lenders may want to restructure PPA terms to accommodate for delays or performance shortfalls, renegotiate payment schedules, or even ensure that the project continues to generate revenue whilst the issues are resolved. So as I mentioned, it's important to note that while lenders do require these step-in rights, these really are dealt with as a matter of last resort. Next slide, I think that's done from me. Thanks, Pug. I'll hand over to you.
Thank you, Amara. That was very useful. I think it's from my perspective as independent of the last two speakers, if you're looking at sort of the long-term financing for a project, then countries which operate a local currency PPA and payment structure, such as South Africa and Namibia as sort of regional examples, this is where the commercial banks really have a dominance in the market on terms of the long-term financing, as well as all the other actions and activities that Amara sort of discussed in her presentation. Where you have dollar debt, then it's more challenging for the commercial banks to provide that long-term dollar debt, which is where the sort of DFIs play a significant role, with FEDA, as he was mentioning there. So in sort of Zimbabwe, Zambia, and the likes, this is where the long-term financing will tend to come from DFIs, but there's still all those other roles, the security agent, the facility agent, etc., which will sort of undoubtedly involve a commercial bank like Nedbank. So thank you very much, and I don't think there was necessarily any specific questions. We'll pick up some others at the end, Amara, but thank you for that presentation.
No, thanks, Pug. And I think you summarized it correctly, that on that basis, then we're able to co-fund with DFIs for such projects. Yeah, so thanks.
Mutali, I'm going to pass over to you as a sort of person who's reached out for financing for transactions. Again, if you can give your understanding of those, I'm going to just share the presentation.
Good. So thank you, Paige, and good morning, everyone. So my name's Talim Kuka. I'm CFO for Copperbelt Energy Corporation, a company that operates in Southern Africa with operations in Zambia and DRC, and we are a utility that primarily supplies power to the mining companies in these two regions. We are a member of SAP, and we're sort of trying to grow our tentacles as a utility. So if we can just move on to the next few slides, maybe. The next slide as well. Just to say that I've been with the business for the last 20 years, out of which the last 11, 12 years or so, I've been in the role of CFO. So this is just an intro of the business, just to show that we have operations in those markets and that we are a member of SAP. We've been a member of SAP since 2008. And we are one of the largest private power traders on the Southern African power pool. So we play in all sectors, that is on the transmission side, on the generation side, as well as distribution and supply. And we are also a power trader. Lastly, just to highlight that we are a listed business on the Lusaka Securities Exchange. So if we can just move on to the next slide, which sort of gives some form of credentials to the business as a developer. So that the things that we talk about, at least there is some credence to it. And in here, I'm just primarily looking at the developments in renewables and specifically just solar. So that's the pipeline that we had. We started very small, with a very small plant of 1 megawatt, to try and test the technology, understand it, use it to build capacity. And then we started scaling up about 5 years later, moved from 1 megawatt to 33 megawatts, and then almost doubled it to 60 megawatts. And at the moment, we are developing a 136 megawatt project. And we also have 2 other projects that are under development, which is a 25 megawatt plant under the Get Fit program in Zambia. And we've got a small 12 megawatt plant, which is a C&I. Now, I want to highlight here that whereas all these are solar plants, the risks attached to these projects are very different. I think it's important that we give context, because as we go in there, then we start looking at the risk allocation, which is slightly different for different projects. So the 136, 33, and 60 are all underpinned on a portfolio basis by one off-taker with a varying off-take agreements from the mining company. So essentially looking at a portfolio of cash flows. The 25 megawatts is underpinned on a ZESCO offtake, and there you see all the key agreements that have been mentioned by FAID in terms of a PPA with the government, the IA that comes in. That's a sort of structure which you won't see in the previous one. A 12 megawatts becomes a commercial and industrial offtake, which is primary to a mine. So again, there the risk allocation is slightly different, and the financing that you attract becomes very, very different. So we see that we've tried to bring in different structures to finance different projects and to try and meet our customers' requirements. So on the next slide, with that said, essentially we thought that it's important that from a sponsor's perspective, we look at what we typically see in the market as the myths and what we find in practice to be a fact. Now, in putting down these sort of points, we have had exposure and experience to talk to various developers who've progressed various projects, and they have these expectations on what value they should attach to their project based on the developments that they have undertaken as at that point. Now, what we see is that in this part of the world, again, it's another context to this slide, is that typically most individuals or businesses that end up with projects are not necessarily sector experts. So you find various individuals have got concessions, whether it's to a hydro, concessions to a wind site, and when you look at the details on what they've actually done on the project, you realize that there's a misalignment on what they believe is the value of the project relative to what someone like ourselves who've developed projects will see as the value of the project. The first one is that there's no financing for projects. Typically, people say that there's no financing for projects. But if you heard what Fed and Amara said, look, there's plenty of money for projects. The only key issue is that there are very few well-structured projects. So from a promoter's perspective, I think the most important thing is for us to focus on structuring the projects right and allow for these funds to come and flow in there for us to move to financing. The next point is that a concession or just having land, whether it's river rights or just a concession from a government, look, on its own, in our view, does not amount to a project. That is just one piece. What entails or brings about a project or the value to a project is the development activities that have already been ascribed or alluded to earlier, which again, we'll try and talk to. So it's very important that we start seeing the link between a concession and the activities that essentially attach value to a project. The next one is that typically we find that project promoters have a very different perception of the value of a project. when you start talking to them, if they have whatever documents they have, whether it's an initial PPA, they haven't progressed anything else, or even just land. Now, we see this misalignment in expectations and reality. And because of that, you find that they can't attract additional equity to help progress the project, because you still need equity to fund the various activities to help get to financial close of a project. And then, because most of the parties who undertake projects or who have rights to concessions and rights to land where projects can be undertaken, see others who are in the trading business make quick money, they believe that projects can be developed very quickly. In our experience, we don't think so. We believe that projects require a lot of patience, a lot of hard work, and they also require funding, which is typically called development financing, to fund the various development activities to progress the project to sort of financial close. So with this summary of what we believe are the myths and facts, we'll then look at it from a sponsor's perspective to see how a sponsor can then derive the value of a project from concept, depending on the technology, whether you're looking at solar or wind, or indeed it's hydro. So if we can move on to the next slide. So these are the sort of project checklists that you'll see in terms of the key activities. So you'll see that most of these were already mentioned, I think, in Fed's slides. But key to that is that you need to do a pre-feasibility study. And what's important there is to make sure that you've got the land permitting, you've got the ownership. You can also have access to your perimeter, the perimeter fencing of some kind, depending on what you are doing. It really helps when you come to look at E&S, which is the next aspect, and the whole permitting required under the ASIA or the environmental permitting process. The other big aspect is really the resource, because the resource is what will drive the value of the project. Now, it depends on what technology we are looking at. In here, probably we can look at it from a solar perspective. What's the resource that is there? Can you do your energy yield assessment? If it's hydro, then you're looking at the hydrology, the water that is there. If it's wind, then you're looking at the wind speeds and over what period. Again, talking to the various parameters that were mentioned earlier, whether it's a P90, P99, or P50. Now, once that is done, then you need to bring in there the sort of what is the anchor from a commercial perspective, which is really the PPA. But then you still have to come and now do the actual feasibility on the next phase, which brings in the technical, financial, more detailed resource assessment. They make sure that once a project is built, you can evacuate the energy that is there. So grid studies become extremely important. And then you come on to look at the various processes that link into the financing process. I think most of those have been alluded to, but one point I want to highlight from a sponsor's perspective is that to the extent that you are a sponsor and you have undertaken activities in 1 and 2, and you definitely need to bring in, if you want to bring in a partner from an equity perspective, it really, really helps if you've done most of the initial work, because at that point you can justify higher value, not just to your partners, but also from a lender's perspective. I would request that we move on to the next slide, which is looking at our view of how you derive value from a project. Now, we start with the initial pre-feasibility study, which is a sort of step 1, and then you move through the ladder to the feasibility itself, and then structuring, financing, and construction and operation. Now, what we find is that on a typical PPA, you would potentially get value linked to up to about 5%. We see 5% of project value as a development fee for having undertaken the development work. Now, that amount typically is only paid by the time you get to financial close. In certain instances, you find that the first amount is paid at financial close, and the balance is paid once the asset is operating. Now, to the extent that you have a full understanding of the life cycle of the value creation journey in a project, you are better placed to focus your energies on things that will bring the value required from an equity perspective. Well, we find this sort of value creation journey quite interesting and extremely important from an equity perspective, because sometimes we find that little knowledge in project development is more harmful than no knowledge at all. And because of that, you find that there are very few projects that get to financial close on the continent. For those who attend the Africa Energy Conference, you find that year in, year out, people are advertising and talking about the same projects over and over, but none of those projects are getting to financial close. And partly, one of the reasons why those projects do not move is because the project sponsor's expectation of what value is ascribed to there, and they also don't have sufficient financing to get to step 5. And because of that, you find that projects do not see the day of light. On the next slide, we essentially are looking at we're looking at how long it takes to move a project from concept to sort of COD. Now, the timeline that we are showing here of 24 months is reasonably an aggressive timeline. And typically, this is a timeline that is normally achieved by partners who have, number one, the capacity to run most of the activities that are in there. Number two, they have the financing to fund most of the activities that are in the project conceptualization, and in part, some of the activities that need to be funded to ensure that the various agreements are drafted by the legal teams in development and design, and also they can fund some of the activities required to undertake a procurement process from an EPC perspective. If most of that financing needs to be sourced from third parties, and you have to fit in the time to source for that financing, negotiate, then you typically find that the timeline may be extended. It might be more than the 24 months. From a construction to operation for the technology, which is solar, our experience is that the best that we can ever get is about 12 months, and that is really, really aggressive. Typically, if you are starting from a land clearing to anthill demolition and road access, as well as perimeter fencing, you find that the standard time that most EPCs will give you will be about 20 months. But if you can undertake, essentially use your equity to finance some of the activities that can be front-loaded, then you'll see that overall, you can reduce the overall timeline to from conceptual starting point to COD. So the point being mentioned here is that this is probably one of the easiest technologies to develop, which is solar, and that we need to be patient and allow for this sort of timeline from concept to commissioning. The moment you change the technology, you start talking about wind, then the dynamics sort of change. If you are in a country like Zambia or you operate in DRC, logistics become a bigger issue because of the size of the turbines, how to move them. And you find that the timeline overall to close a project of that nature to COD will be significantly longer than 24 months. And if you change the technology again, you start looking to hydro, then this 24 months will go way beyond in 2 years. Sometimes you can get a hydro project from concept to operations between 5 to 7 years or so, because of the nature of the technology that you're bringing up. So one point to highlight again here is that these projects require patient investors, and that you need to know what you're doing. If you do not have the resources, quickly bring on board partners who can help you to move the project. It doesn't have to be an operator. You can bring in a financial partner, provide, you can buy a service from an operation perspective. Parties are there who provide services to ensure that they handhold you to move from concept to operations. If we can move to the next slide. The next slide, we're essentially just asking the question, why is there a growing need for renewables? And I guess this is a topical issue, and those are the various reasons. We've seen over the last few years that this is quite competitive. Just to give an example, a couple of years ago, probably it must have been 2011, 2012, we were looking at some solar projects in West Africa. And at that point, as well as the first refit projects in South Africa, you find that the cost per megawatt for those solar units were coming up to about 2.5 on average, $2.5 million per megawatt. The latest projects that we developed as CEC with more advanced technology is yielding a price of just about 0.7, 0.8 million dollars per megawatt. So you can see that over the years, there have been a significant reduction in the price of panels overall. And what we are also seeing is that there is also a significant reduction and improved sort of technical solutions for storage, which makes it easier and better for sort of C&I type solutions. But also, we've seen that most of the governments have provided sufficient incentives for overall renewable to come in. There is also carbon pricing, and to some extent, they are sort of bringing up emission regulation here and there, which sort of is pushing more developers from fossil fuels to this type of technology. The other big point as to why renewables is just around most of the off-takers. Their financiers are seeking of them to get some form of green certification as they offtake for power. So to the extent that you've got some green certification and you're able to give it to them, they help the group company to sort of tick the boxes from their financiers, then they'll go for those sorts of power sources as opposed to others. And the last point is that it can be implemented in a scalable manner, which means that you don't have to have all the resources. You can size it as a big project, but implement it slowly. It's also ideal for sort of microgrid and off-grid solution. And maybe the other one important point, which was not highlighted by the financiers, is that there are a lot more windows financing for renewables, which we are seeing, which is slightly different if we look at alternative sources of technology. So from that perspective, we believe that renewables, as of now, it's the in thing. It's if you are a developer, it is probably where you want to be, and with everything working for it, you can structure a project, and there are a lot of parties who can handhold you and help you to get to financial close. On the next slide, please. Yeah, this is probably more from a broader perspective, whereas there are very specific issues from a technology perspective. What we are also seeing is that the landscape, and by landscape here, I'm sort of trying to limit it to Southern African power pool, is that it's significantly changing. So if you look at it from Southern Africa power pool, if you look at the trades that we used to have a couple of years ago and where we are now, there's increased trades on that market. And as the markets sort of start increasing in trade, it definitely allows for more liquidity. With more liquidity, we start seeing solutions such as the solution that Fed was talking about, where projects can be banked on the trades on the market, which is extremely positive. But that also calls for more regional interconnection. With more regional interconnection, then you're bringing suppliers and buyers together, essentially trying to match them, and that will help to grow the market overall, as opposed to looking at it from a country perspective. We're essentially looking at SAP as one market. And that in itself, we believe that will significantly help to provide alternative financing structuring options for developers and lenders together. The last thing is that we've also seen different governments come up with their in-country changes to regulations. So if you look at South Africa recently, they've implemented something similar to what Zambia is doing, which is a sort of open access. And that in itself means that projects can easily be banked between commercial and industrial, which provides a sort of unique value proposition for both developers and off-takers, but also it allows for the consumers to get the required green certification, which most of their investors require. But additionally, you can come up with very customized solution, which means that the market is there. The different countries have opened up their markets to allow for private sector investments. It's not a secret that most of the countries on the continent are not able to fund most of the infrastructure that is there. And what we have seen is more governments trying to push for private sector-led infrastructure spend in the various areas, and that this is true in the power sector as well. So what we will see is more refinement of the regulations, both at regional level and in the respective countries, which will allow for more sort of development and financing in this sector from the private sector. The next slide, please. I guess with that sort of summary, CEC undertook a sort of green bond to fund the projects that I mentioned earlier. Now, why did we go for a green bond as opposed to a sort of direct bilateral loan, or even why not just a sustainability linked facility? Now, there were a number of considerations. The first consideration was that there are sufficient incentives in Zambia, at least, to allow for green bond financing to get the required exemption as it relates to tax, withholding tax specifically. With that, it means that from a business perspective, you can create value but also you can use that to attain the green certification that is much required from a number of our mining off-takers. The second point is that there's a growing pool of capital that require a sort of link to ESG or that are sustainability focused investors. And because that is there, we thought that it's an important aspect for us to tap into that market. And this was the sort of first green bond in country. We haven't seen that many green bond issuances, even on the continent. They are there, but they are not that many relative to what you find in the West. We also see that you can get reasonably good tenors. You can get very long tenures. In our case, we got 15 years. And you can do it on a project finance basis, which was the case. But it also provides sufficient flexibility to allow the business to sort of grow. But more importantly, it helps the business in the attainment of the goals as it relates to the environmental commitment and some of the sustainability and climate action that we've signed up to. And lastly, I guess there is also this marketing aspect, which comes in, which is also a key consideration from a branding perspective that sort of strengthen the brand, but there are also positive perceptions around that. So if you look at the next slide. Now, I'll sort of give some of the positives and some of the things that I believe from a lender perspective can be better considered, especially for parties who are operating in this part of the market. Some of the positives is that there is access to technical assistance facilities, which is very, very good. As long as you're patient, you can work with DFIs to get some of these financing required to fund the various studies that go into helping the projects to be bankable. There is also concession of facilities. You can get some financing probably at close to 0% to fund some of these developmental activities, which you then pay back at financial close. And something that is quite important is that there is a process of hand-holding between the investors and the promoters, because you're sort of working together for a common goal of getting the project to financial close. And the last and more important point is that in the end, you end up achieving a sort of an effective risk allocation from a financing perspective, which is very good from a sponsor perspective, because then you have the project in the long haul, and also it significantly minimizes the risk of default from a lender perspective. So those are very, very positive attributes, our experience. However, there are things that we believe can be improved. Now, broadly speaking, what we find is that some of the geopolitical tensions in the world somehow end up impacting on the financing considerations for various projects. Now, our experience is that if you go to market, typically the Western EPCs are not able to compete at the same level with some of the EPCs from Asia. But because of some of those geopolitical considerations that are there, you find that the level of scrutiny that comes in sometimes can be overbearing from an EPC scrutiny perspective. I think it's well understood that some of the EPCs and the manufacturers, specifically the equipment manufacturers out of a certain region in China, there are allegations of them using modern day slavery to produce that, and most of the financiers wouldn't want to do that. But over and above that, the point being mentioned is that we can improve in the managing of that. The second aspect is that you know, we can better manage the use of the advisors, the various advisors, which I think various parties have spoken to, whether it's legal, technical, E&S, insurance, and so on. We think that for this part of the market, as an example, if you picked a sort of English or international council out of London, and you pick an English or international council out of South Africa, all of them talking to English law, you find that the cost differential is like night and day. So from a sponsor perspective, it would be good if we worked with financiers and essentially brought in the skills that are on the continent, which are competitively priced for projects on the continent. I think that would go a long way in ensuring that the project costs are lowered, but more importantly, that there is sufficient value that is left on the table for parties on the project to share into. And then one other point to highlight is that, look, the market is sort of changing. We've highlighted the regulation change at regional level, respective countries within SAP, but what we have noted is that not all DFIs, not all lenders are open to that change. Everyone is sort of still sticking to the traditional way of financing, of looking to the government to underpin each and every project. But look, most of the governments in this part of the world are either in default or they are overly exposed. So I think the key point there to lenders is how can we work together to ensure that we come up with more innovative ways of financing these projects. And I'm glad to say that the projects that we financed at CEC, we had very good lender groups who came through, and look, they definitely did what they needed to do to ensure that the projects crossed the lines. I note the project that Africa GreenCo is doing that is extremely innovative. It will be the first one that will be banked on the SAP market from a bankability perspective, and that's the way we would want to see the market evolve as developers. The last point I thought I should highlight, linked to E&S again, is that half the time when you have consultants coming in from outside the continent, they sort of miss the local context. And look, if you are in Zambia, this is a very practical point. If you are in Zambia and you're on a construction site, typically people will have the local meals which they cook on site. But the expectation from an outside E&S expert is to expect that they should find fancy chicken and chips on site. Now, typically you won't find that, but even if you did, it just changes the cost structure to the extent that you can do, you are able to deliver that on site. But half the time, even if you provided the chicken and chips, even the workers themselves might not be happy with what you're providing them, because there's context to how they live, what they eat, and how they want to feed. So we think that it's very important that the various advisors are brought to book on the local context aspect of the issues on ground, and it also speaks to some of the issues around land and so on. We believe that local context is extremely important. That also speaks to issues around labor, because look, whereas the IFC performance standards are very, very important, they can't supersede the local regulation. If the local regulation provide for a certain minimum for an employee to join, let's say to join a union, You can't force them to join a union outside the local regulation. So there are those sorts of issues that we believe that become extremely important for both the lenders and the advisors to abreast themselves. The next slide, please. Yeah, overall from a fundraising experience, and this is specific to the green bond, again, we noted that in this part of the world, we need to build capacity, and that capacity speaks to everything. We're talking about capacity to audit the green impact reporting, the second opinion on the green bond framework. We, at the time we're doing the bond, we didn't have capacity in country, at least, to do most of these things. So the onus is how can all the key stakeholders, whether it's audit firms, it's all the parties that are involved, how do we divert how can we divert the capacity to make sure that in country we have most of these advisors who are able to do that. The other things is that from a project financing perspective, sometimes you find that there's limited skills in country, and you have to bring in the skills outside. But also, it's important that there's alignment of the various regulations within the countries. Now, we've noted that the green mandate, at least from a Zambia perspective, has not been adopted by most financiers. And here we're talking to local banks and pension schemes and it becomes important that some of these initiatives are sort of are being pushed through. But overall, it's also just an education of what is the project finance and how does the green mandate link into the various projects that an institution will be looking at. On the positive side, look, the regulators are well capacitated. They've worked hard to ensure that they understand these things. So what we saw was night and day between the understanding of the regulators and the policymakers in country compared to what the market have. And then from being proactive to want to see a solution, I think the regulators and the policymakers are up to the task. I think that was, do we have any other slide there? Yeah, this was just an overview of the transaction that we previously did, which was a $53.5 million. And I must highlight that we will be closing another tranche, hopefully within the course of this month or before year end, which will be about double the size of what we had to fund the pipeline that we are looking to. So maybe I can end here and Paige, hand over to you. Thank you.
Thank you, Vitali. That was excellent. Very interesting to sort of get your perspective from, you know, as someone who's looked at the financing from as a user of that. Quick question really around on your green bond. I mean, you know, this, you know, without you know, people starting these initiatives as you have, which is fantastic and creates that sort of start of a track record in the market. You know, these things never really develop, and that's obviously something that's akin to GreenCo's ambitions as well. But would you see this as being sort of a viable option now for a new project, or is this sort of working now for you because of your track record, experience, etc., that you've developed, and it might be a bit of time before sort of others can start to use a sort of green financing as an alternative to bank financing?
Yeah, no, I definitely think that it's a very good option, not just for ourselves, but I think that it helps if the party that is going to market is one that essentially would tick certain boxes. The first box is that you should be open to transparency and people should see through you. Now, a number of investors are not quite open to that. So to the extent that you are comfortable with that, then this is the financing for you. The second aspect is that it sort of helps if you can build up capacity, because if you look at it from a green financing, to some extent, it's not necessarily your traditional type project finance. To some extent, your financiers are also heavily reliant on your governance, which means that you need to have very strong governance in place to give them assurance that, look, whatever you say you are able to do, and they can get comfort from the quality of individuals you have on your board, as well as your key management, and your sector specialists, especially individuals who are driving your E&S, individuals who are driving your operations. I think it's very important that you have individuals who the lenders would be comfortable with. So to the extent that you can tick those sort of boxes, I think this is the financing for you. But also, we're seeing that there is more and more competitive windows that are coming up to go in this window. So if you tick those boxes, I definitely see this as an alternative financing option for project finance.
Excellent. And maybe to give people an example of the patient capital you've had, you mentioned your Get Fit project that you've been developing, and unfortunately that's been a few years under development. Do you want to sort of give an indication of how long that has been?
Yeah, so we were first awarded the Get Fit project in 2018, and look, between 2018 and today, we've sort of done rounds where you spend on various activities, and the project stalls, and then you come back. So this is more or less 6-7 years we've been at it, and that's a lot of patience. But over and above that, look, I can talk to one other project that we started in 2007. It's a project called Kabompo Hydro. We spent some money in there. It's yet to reach financial close. We're quite hopeful that one day we'll get to financial close. But it highlights the need for patient capital, I think, for project development.
Yeah, I totally agree. Unfortunately. I mean, we all hope, and the plans for the ambitions for us all is really to be able to speed that up. And I think one of the key ways of doing that is making the deals as the more limited involvement of government is the best for that. And not, that's not a slight against governments, but it's more that can take a little longer because of their sort of requirements, and they have a number of other initiatives.